So, hello everybody, welcome to this English amendment video for CA final direct taxes and national taxation applicable for May and November 25 attempt. In this crisp and elongated video, we will try to cover up all the amendments that are applicable for your examination. You might see most of the questions, or if not most, many questions from these amendments. So, these amendments are really very important for your examination. Sir, what you have to do, you don't have to do anything. You just sit back. You just have to listen what I'm saying. Along with that, you just need to take your books. If you have amended books, you don't need to incorporate anything. Everything is incorporated. You just need to understand everything with me. Or if you don't have new books, you just take your old books, take the pen with yourself and strike down the older provisions as I say and incorporate the newer provisions as I utter along with the video. Sir, how will you get the PDF of this amendment sheet? I have uploaded this on Telegram channel. You can access it from my Telegram channel. The link is in the description box. So let's start without wasting any time. Chapter number 1, sir, basics. What are the changes in basics tax rate? Sir, not much. Actually, there are not much changes. A few things have changed in tax rate. Remember, in case of company, for previous year, you used to take the turnover of 21-22. If a company had turnover exceeding 400 crore, then tax rate was 30%, else it was 25%. If you remember, tax rate was 30% if turnover for previous year 21-22 was exceeding 400 CR. But if it was below 400 crore, then we used to take tax rate 25%. Now, since we are going ahead in previous year, so tax turnover we have to check for previous year 20 to 23 and not 21-22. This was a common sense. You might have got this point without me telling you. So it is very much clear. So major change is not in this point. Major change is in the tax rate of a foreign company. Earlier, foreign company was taxable at the rate 40%. Now this tax rate has been substantially reduced to 35%. So you need to change this in your book. If you are having older provisions, this has to be incorporated in your books. Sir, what impact this amendment can have? This amendment can have impact in your multiple NR taxation questions. Earlier, when we used to solve the questions of NR taxation, we used to apply 40% tax rate, but now every question will be solved with 35%. So this is a major impact. This you have to incorporate in your books. Got it, sir. Got it. So two amendments. We have to check the turnover for previous year 2023, that is 400 crore, and we have to apply tax rate at the rate 35% for foreign company. What else amendments do we have in this chapter? Sir, one amendment in section 115 BAB. You remember, if we used to incorporate new manufacturing entities, then we were entitled for a reduced tax rate of 15%. If you remember, under section 115 BAB, we were entitled for reduced tax rate, or I should say concessional tax rates. For that matter, our company, our manufacturing operations should have commenced before 31st March 2024. Our manufacturing operations should have commenced before 31st March 2024. But now the date has extended. Since previous year has extended, so date has extended. Now you can commence your operation till 31st March 2025. If you commence your operations before 31st March 2025, you can still be entitled for this concessional tax rate under section 115 BAB. Not major amendment. This was a common sense. Similar provisions for 115 BAE. If you start a manufacturing cooperative society, then date for incorporation and commencement of business is 31st March 2025. If you commence your operation on or before that date, you will be entitled to this 115 BAE. Similar provisions, nothing new. Sir, major change has occurred for your attempt. Tax rate for individual under section 115 BAC has changed. Earlier, whatever the tax rate used to be, you don't need to remember at all. You just need to remember the tax rate what is given now. Just note the tax rate along with me. Up to 3 lakh rupees, no tax rate. From 3 lakh to 7 lakh, tax rate will be 5%. From 7 lakh to 10 lakh, tax rate will be 10%. From 10 lakh to 12 lakh, tax rate will be 15%. From 12 lakh to 15 lakh, tax rate will be 20%. And exceeding 15 lakh, whatever income you earn, you will be taxed at the rate 30%. Only slight change in tax rate, but major impact in question answers. Whatever questions that you used to solve in DTAA or other chapters will change because of this tax rates. Tax calculation will change. So you have to incorporate this tax rate and you have to learn this tax rate by heart. Sir, how can we learn this tax rate? Just remember, taxes on income up to 15 lakh will be 1,40,000 rupees. And whatever the income that is exceeding 15 lakh, you have to calculate at that 30%. Like for example, if you have income of 20 lakh rupees, just to split the income up to 15 lakh, taxes will be 1.4 lakh, and 5 lakh above income will be taxed at the 30%. You can solve this, you can solve in this way. ICAI also does in the same way. You need not to worry about it. You just need to remember this tax rate by heart. Up to 3 lakh, no tax. 3 lakh to 7 lakh, 5%. 7 lakh to 10 lakh, 10%. 10 lakh to 12 lakh, 15%. 12 lakh to 15 lakh, 20%. And exceeding 15 lakh, it will be 30%. This is the basic tax rate that you have to incorporate under section 115 BAC. Do we have any amendments? Sir, we do not have any amendments. Yes, sir, we do have. We do have. Remember, under section 115 BAC, a salaried employee was also entitled for standard deduction at the rate 50%, 50,000. This standard deduction under section 16 for a salaried employee was allowed at the rate 50,000 rupees under both the regimes previously. It was allowed under both the regimes. 50,000 rupees was allowed in both the regimes, under normal regime also and under new tax regime also. It was allowed. But in new tax regime, just to appreciate the people to opt for new tax regime, government has increased the standard deduction limit to 75,000. Now you will be entitled for 75,000 of standard deduction if you opt for 115 BAC. If you pay taxes under 115 BAC, you will be entitled for 75,000 rupees worth standard deduction. This is also one of the change. Is there any change in chapter number 1? No sir, no else change. Now the chapter that has most changes. Now, the chapter that has most changes is the capital gain. And sir, what has changed? First of all, sir, period of holding. The period of holding has changed significantly. Before understanding any change in the capital gain chapter, you first need to understand that every change that is being done in this capital gain chapter is done in mid of the year. That is budget date. You just need to remember this budget date throughout your income taxation. You just need to remember this budget date throughout the session. Any change that has been done on this budget date, sir, will apply prospectively. That means change will apply with effect from that date. So whatever the provisions that were applicable before that budget date will apply as it is. Will apply as it is. So for example, if tax rate has been changed from 23rd July, that will apply prospectively. But if there is any transfer of any capital asset before that budget date, it will be taxed at provisions. It will be taxed at earlier provisions, old provisions. So this point must be kept in mind while understanding the amendments in capital gain chapter. First of all, the major amendment has been into the definition of period of holding. We already know if we have any kind of long-term capital asset, capital gain will be long-term capital gain, or if there is any if there is in short-term capital asset, then capital gain will be short-term capital gain, except for a few exceptions. How we used to define a capital asset as long-term capital asset or short-term capital asset? We used to have a period of holding for that asset. For example, we used to have, if there were any listed securities other than units of business trust recognized or listed on recognized stock exchange, or we used to have equity oriented mutual funds, or we used to have zero coupon bonds or units of UTI. If we held them for more than 1 year, then they were long term, otherwise they were short term. We have studied this. If we had any unlisted shares other than shares covered above, or removal property, if we held them for more than 2 years, then they were long term, otherwise they were short term. And any other asset, like we had gold, we had debt oriented mutual funds, or any other asset that is not covered in first and second category, we used to have 3 years of period of holding category. If we held for more than 3 years, then it were long term, otherwise they were short term. This was the existing provision. These were the existing provisions relating to period of holding. If we held these specific assets for their period of holding, then they were long term, otherwise they were short term. But amendment proposed certain changes. Amendment in Finance Act proposed certain changes. What it said? It said listed securities on recognized stock exchange. Now, listed securities also include units of business trust. Earlier, what used to happen? Business trust units were having period of holding for 3 years. If you held units for 3 years, then they were long term, otherwise they were short term. But now, with effect from 23rd July 2024, units of business trust have period of holding for 1 year. Now, if you have units of business trust held for 1 year, then they will be long term, or any other listed securities held for 1 year, they will be long term. If you have any equity oriented mutual fund held for more than 1 year, it is long term. If you have zero coupon bond held for more than 1 year, it is long term, or it is equity oriented mutual fund held for more than 1 year, it is always long term. Second major change that is being done in this period of holding concept is, sir, any other asset, sir, if you held for more than 2 years, it is long term, otherwise short term. Now we do not have any concept. We do not have any concept of 3 year of period of holding. We do not have any concept of 3 years of period of holding. Any asset, if held for more than 2 years, it is long term. You don't need to check anything else. You don't need to check anything else. Did you get this point or not? Did you get this point or not? So, sir, what things have changed? Earlier, when you used to sell gold before budget, then you used to check it for 3 years. But if you sell it after budget date, you have to check period of holding of 2 years only. Before budget, if you used to sell units of business trust, then you have to check the period of holding for 3 years. If you sell it after budget, you just need to check period of holding for 1 year. Just take example. What happened is, sir, if you buy units of business trust on 1st April 2023 and sell it on 22nd July 2024, according to old provisions, since budget was applicable 23rd July now. So if you sell it before budget, then you have to look the old provisions. And as per old provisions, units of business trust are short term because you have not held them for 3 years. They were short term because you have not held them for 3 years. But if you hold just for 2 days, if you hold for 2 days and sell it after budget, 24th July 2024, then provisions have changed. After budget, you just need to check for 1 year period of holding. And if you hold them for more than 1 year, then it will be long-term capital asset. Have you held them for 1 year? Yes, sir. I have hold them for 1 year. So in that case, it will be taxable as long-term capital asset. This is what have changed in the budget. Did you get this point or not? Yes, sir. We have got this point beautifully. We have got this point beautifully. Okay, sir. Another change that is being done is under section 47. If you want, you can take screenshot of this page. You can write it down, or otherwise, I will be sharing this PDF on the Telegram channel. You can also write it down from that thing. Okay, sir. Section number 47. What section number 47 says? Section number 40 says transactions that are not regarded as transfer. They look like transfer, but they are exempt transfer. Even if you have certain capital gain on that transfer, they will not be treated as transfer. They are exempt transfer. In that definition, in the second line, we used to have any transfer of capital asset under gift will by individual HF. What used to happen? If I give any of my asset to Deepika Padukone, it was exempt for me. It was exempt for me. Sir, if I transfer any of my gift to any of my favorite student, if I transfer my house to any of my favorite student, it was exempt for me. No capital gain used to arise in my hands. These were the earlier provisions. Right now, also no capital gain will arise, but this provision is restricted to only individual and HUF. Earlier, when company or partnership firm or LLP used to gift their assets to any other person, then capital gain was not arising. But now this provision is just restricted to individual and HUF. So you can write down by individual HUF. Any transfer of capital asset under gift will by individual HUF is exempt. By company firm, it will not be exempt. This is the major amendment that you have to go through. Got it, sir? Got it. Nothing new. Very simple point. Now, section number 48, the most beautiful section. The most beautiful section. What this section says? This section says computation of capital gain. How capital gain is computed? So full value consideration minus transfer expenses will give us net consideration. Any kind of deduction like cost of acquisition or any kind of cost of improvement will be reduced, will give us long-term capital gain or short-term capital gain depending upon period of holding. This is we already know. This is something we already know. So there is a single concept here. Either we have to reduce cost of acquisition or we have to reduce index cost of acquisition. If capital asset is long-term capital asset, then you have to reduce index cost of acquisition. This is what we have studied. Yes, sir, this is what we have studied. But with effect from 23rd July 2024, indexation benefit has been scrapped. Now you will never be allowed indexation in any case. No capital asset will be sold with indexation. No cost of acquisition will be indexed if it is sold if it is sold after budget. You just need to remember no indexation, no indexation, no indexation, no indexation, no indexation, no indexation at all. Now, if you sell any kind of asset, if you sell gold, if you sell before budget, but indexation allowed. If you sell after budget, no indexation allowed. If you sell property before indexation, before budget, indexation allowed. After budget, indexation not allowed. At least for capital in competition, it is not allowed. You need to remember this. Sir, but we have studied for tax calculation, indexation will apply. I will tell you how tax calculation will work out. But for that matter, for the purpose of calculating total income, you need not to take care indexation at all. You need not to take care indexation at all. You have to remember this point by heart. Before budget, indexation available as it was available previously. After budget, no indexation at all. You need to remember this point. Got it, sir. Got it. Clearly got it. Sir, for your attempt, even if you are transferring assets before budget, indexation will apply, and indexation's CII will be 363 for your previous year. Got it, sir. We understood that point. Clearly, we understood that point. What changes are there in capital gain? What else changes are there in capital gain? Not much. Yes, in capital gain. In capital gain slump sale. See what change was actually exactly, just understand. Period of holding has been reduced from 3 years to 2 years after budget. As soon as budget was announced, every asset that was held for 3 years has been turned to 2 years period of holding. Like previously, if you hold for 3 years, then it was long term capital gain. Now if you hold them for same asset for 2 years, it will be long term capital gain. Period of holding has been reduced from 3 years to 2 years for every asset. But this is not the case with slump sale, because slump sale is not being governed with section 45, it is being governed with section 50b. So for slump sale, the period of holding will be 3 years intact. I have written down before budget, after budget, that has been cut, that has been crossed by me in classes also, and I have also striked it down by while I'm teaching the power batch also. For any other batch that I have taught, I have necessarily or intentionally correct. I have intentionally made it wrong and asked you to correct it. So what you have to remember is, whenever you are having any capital gain for slump sale, you just need to check period of holding for 3 years. If you held that undertaking for more than 3 years, then it will be long term. Otherwise, it will be short term. But it's sir, we understand this point. What else amendments are there? Sir, there is amendment in section 50 AA. Do you remember section 50 AA? Till last year, section 50 AA was introduced. Last year, Finance Act 2023, 50 AA was introduced. Under section 50 AA, two securities were mentioned. What two were there? First of all was market linked debentures. If you had any kind of debentures whose interest is dependent upon market conditions. For example, Mr. A and Mr. B. Mr. A issued a debentures in which he promised that he will pay interest at the rate 90% as per the growth of the Sensex. For example, if Sensex grows by 20%, he will pay 18% interest. If Sensex grows by 40%, he will pay 36% interest. If Sensex grows by 10%, he will pay 9% interest. Whatever the growth market gives, he will pay 90% of that as interest. If any kind of debentures that are being linked to market, that are market linked debentures. In the similar series, we had specified mutual fund, any kind of mutual fund that are being issued on or after 1st April 2023. And in that mutual fund, less than 35% of the total proceeds are invested in equity shares of domestic company. Less than 35% of the total proceeds are being invested in equity shares of domestic company, then such mutual funds are specified mutual fund. What was the case? Why this section was introduced? Just to make sure that any kind of capital gain arising from such asset shall be long term, shall be short term capital gain, and no indexation was ever allowed against these assets. This was the case for 50 AA assets. Now, continuing that series, Nirmala Sitharamanji added another type of category, another type of asset to this series. She said any kind of unlisted bonds or debentures, any kind of unlisted bonds and debentures that are being redeemed on or after 23rd July 2024. On or after 23rd July 2024 will be always short term, and no indexation will always be allowed. No indexation will be allowed. Even though on bonds and debentures, we never used to get any indexation. But in this case, it will always be short term. You can never have any long term capital gain in case of unlisted bonds and debentures. Whether they are being redeemed or they are being sold at any profit, any capital gain will be short term. They are being added to the list of section 50 AA securities. They are being added. What she says, any capital gain rising from transfer or redemption of bond debenture on or after 23rd July 2024, which are not listed on recognized stock exchange, shall be computed under this section. How it will be computed? Sales consideration minus transfer expenses minus cost of acquisition without any indexation, always short term capital gain. Always short term capital gain. Do you get this point or not? Yes, sir, we did get this point. Now, major change has occurred in tax rate. Major changes occurred in tax rate. First of all, we need to understand the briefing of what has changed. Under section 112A, under section 112A, what used to happen before budget was you were taxed at 10% over and above 1 lakh. You were taxed at the rate 10% over and above 1 lakh. But this 1 lakh has been changed 1.25 lakh, and this 1.25 lakh has been changed for whole year. That means if you sell even before if you sell even before budget, you will still be not taxed up to 1.5 lakh, 1.25 lakh rupees. If you sell any kind of securities and your capital gain is up to 1.25 lakh, even before budget, you will still not be taxed. That means tax rate is applicable over and above 1.25 lakh of capital gain at this point. But before budget, whatever the tax rate was 10%. After budget, this tax rate has been increased to 12.5%. This tax rate has been increased to 12.5%. So now what you have to check in previous year 24-25, if you have any kind of capital gain, any kind of capital gain under section 112A, you just need to find out, reduce 1.5 lakh of 1.25 lakh of capital gain, and you have to check whether the securities are sold before budget or after budget. If they are sold before budget, 10%. If they are sold after budget, 12.5% tax rate. As simple as it can be. If they are sold before budget, 10%. If they are sold after budget, 12.5%. As simple as it can be. The securities under section 111. What 111 is? 111 is says any kind of equity shares, any kind of equity oriented mutual funds, or any kind of business trusts that are listed on recognized stock exchange. They are listed. Earlier, we used to have 15% tax rate, which has been changed to 20%. And this change has been done in mid of the year. If you sell before budget, 15%. If you sell after budget, 20%. Other STCG, like if you sell gold for short term, if you sell any kind of immovable property for short term, earlier you were taxed at slab rate. Now also you will be taxed at slab rate. But sir, there has been major change under section 112. Earlier tax rate was 20%, but you used to get benefit of indexation. But now tax rate has been reduced to 12.5% and no indexation is being allowed to you. No indexation for any property it has been allowed. There are certain complications in this case. We will study one by one. Just have patience with. Sir, 112, what it says. Long-term capital gain on certain assets, what this says. Any kind of equity shares, equity-oriented mutual funds, units of business trust. Got it, sir? Got it. Taxable at the rate 10% if they are transferred before 23rd July 2024, and taxable at the 12.5% if they are transferred after this, beyond the capital gain of 1.25 lakh. Whatever the capital gain of 1.25 lakh is has to be reduced, and then whatever the capital gain is, you have to check when the asset has been sold. If it is sold before budget, then 10%. If it is sold after budget, it will be taxable at 12.5%. Got it, sir? Very much clear. Very much clear. Similarly, for 111, it says before budget it will be 15%, after budget it will be 20%. You just need to check the rate of the budget. Major change has occurred under section 112. What it says? Just let me give you a perspective. This what 112 used to say previously. 112 used to say previously. If you sold any kind of assets, any kind of long-term capital gain under section 112, you were taxed at the rate 20%, but indexation was allowed. Indexation was allowed. But there were two exceptions, if you remember. I'm not sure that you remember or not, but if you remember, there were two exceptions to this. What exception? If non-resident or foreign company sold any kind of unlisted shares in India, they were taxed at 10% only. They were taxed at 10%, if you remember or not. If you remember or not. Sir. And also there was one more exception to this, that if you sold any kind of listed securities, listed securities, but not covered under 112A. Any kind of listed securities that are not covered. Sir, what are the listed securities that are not covered? Sir, any kind of bond debentures. Any kind of securities that are not traded to recognized stock exchange, they are not covered under 112A. They are not covered under 112A. So any kind of such securities will be taxable at the rate 10% without indexation or 20% with indexation. This was so the case of 112A. This was the case of 112A. Like tax rate under section 112 was these three. Normally 20% with indexation. Non-resident foreign company taxable at the rate 10% if they sell any kind of unlisted shares, or if you sell any listed securities which were not covered under section 112A, you will be taxed at the rate 10% without indexation, 20% with indexation, whichever is beneficial for you. This was so the tax rate before budget. But budget brought certain changes. Budget brought certain changes. Listed securities, no, we don't understand 12.5% without indexation. No, 12.5% without indexation. Non-resident foreign company, unlisted shares in India, 10%. No, we don't understand this 12.5% without indexation. What are you saying? What are you saying? Long-term capital gain 20% with indexation. Arey Baba, we have already scrapped indexation, 12.5% without indexation. Oh my God, what the great thing they did. Whatever the complex tax rates under section 112 were, they have reduced everything. They have all normalized it to 12.5% without indexation in every case. Did you get this point or not? Yes, sir, we did get this point. Let's have a look at this. Resident individual HUF earlier 20% with indexation. Other SSC 20% with indexation. Non-resident foreign company, any kind of unlisted shares 10% without indexation. Other assets 20% with indexation. Any kind of listed securities 10% or 20%, whichever is beneficial. Everything is reduced at the rate 12.5%, 12.5%, 12.5%. But one benefit is given. You remember after budget there was a cheer in there was too much of nuisance going around, too much of noise going around, that indexation has been restored, indexation for immovable property has restored. Actually it is not restored. As soon as budget was launched, government proposed a change. Government changed that if any individual or HF, if any resident individual or HF, if they buy property before budget and sell it thereafter. If you buy property, immovable property before budget and sell thereafter, sell after budget, then for the purpose of calculation of total income, you will not be allowed indexation. But for the purpose of calculating taxes, you will be allowed indexation. For the purpose of calculating taxes, you will be allowed indexation. Did you get this point or not? Sir, how things have changed? How things have changed? Just understand this point. Just understand this point. How the provision have changed. Just understand this with an example. So, for example, we have Miss Jia opting for 115 BAC. If she buys a mall property on 1st April 2021 for 2 lakh rupees and sells on 25th sells in previous year 24-25 for 10 lakh rupees. If she sold such property on 1st April 2024, then of course she sold before budget, so she will be allowed indexation. She will be allowed indexation. Yes, sir, she will be allowed. And other income of Jia is 4 lakh rupees. So, sir, total income turns out to be 6.4 lakh, like other income is 4 lakh. And if you index this cost to 2 lakh divided by 100 into 363, you will get something like 7.26. And the capital gain will turn around 2.74 lakh. Her total income will turn out to be 6.74. This was the case before budget. This was the case before budget. Whatever the tax rate was before budget, everything was taxable at the 20%. So this capital gain was taxable at the 20%, and other income was taxable at the 5,000. In total, she was taxed at 59,800. But she was allowed rebate under Section 87 at for 25,000, and her net tax liability was 34,800, including education cess. It turned out to be 36,192. If you are not comfortable with numbers, you can revisit this video again and again. This will be with you only. But what budget has changed now? Since if this property is being sold after budget, no indexation will be allowed. No indexation will be allowed. So, sir, other income other income is same only. But but capital gain income will change. Now only you have to take sales consideration minus cost of acquisition will be 8 lakh rupees. Because of which now your total income will increase. Because of which your total income will increase. And because of which, even though your tax liability remains same, because in calculation of tax liability, you have to check with indexation. With indexation, your tax liability, see what happens. If you consider with indexation, your tax liability turns 58,000. If you consider without indexation, your tax liability turns 1 lakh. Whichever is beneficial, you can take. For remote property, you just have option. You just have an option. Take before indexation at the rate 20%, or after index, before indexation 12.5% as per the new tax rate, or 20% with indexation, whatever is beneficial to you. So even though tax liability has not changed, because even though you are allowed to take the benefit of the old tax rates, you are allowed to take benefit of the old tax rates for the purpose of, you are allowed to take benefit of indexation as per old tax rates. But still, there has been something changed. There is something changed. Even though you are allowed indexation for the purpose of tax calculation, you are not allowed indexation for the purpose of total income calculation. And what has this has resulted in increase in total income, because of which your total income has now increased. And since your total income has increased, you will not be allowed rebate under Section 87A. In case you have big capital gains, your total income will increase substantially, and because of which your surcharge will also increase. If you have big capital gains, you are not allowed indexation. What will happen? Sir, your exemption has to be on bigger amount. You have to claim exemption by buying assets of bigger value. And sir, earlier you used to get the benefit of losses while indexing the cost. Now no losses will be allowed, since you are not allowed to index the cost. So for that matter, indexation will not be allowed while computing the total income. but it will only be allowed at the time of tax calculation for individual and HUF if acquired property before budget and sold thereafter. That is what given in your book. What it says, in case of immovable property acquired before 31st before budget and sold thereafter, lower of 20% or 12.5% will be payable. Lower 20% with indexation it will be allowed, 12.5% without indexation it will be allowed. This is the major change that has come this chapter. What else in this chapter? Nothing, dear friends, nothing else nothing else has changed. Did you get this point or not? Just tell me, did you get this point or not? Continuing further, what amendments are there in income from other sources? Not major as such, but let's see one by one. First of all, under the definition of deemed dividend. Do you remember deemed dividend? Whenever company distributes any money to shareholders, it is considered as dividend. Or any kind of asset that are being distributed are considered as deemed dividend. Or any kind of assets at the time of liquidation, any kind of asset distributed at the time of reduction on share capital is considered as deemed dividend. Or any kind of increment in the liabilities of the shareholders is also considered as deemed dividend. Do you remember those things? Or any kind of money given as loan or advance to the shareholders, which are having substantial interest in the company, is considered as deemed dividend. From section 222A to 222E, we used to have certain definitions which were deemed dividend. Continuing in the series, government also introduced another section, that is section 222F. This section says any kind of money received by the shareholders on account of buyback made by the company will also be considered as deemed dividend. For example, if I have 100 shares of Reliance and company proposes a buyback and takes away all the shares from my hand and pays me any kind of money, whatever money that I am receiving will be considered as deemed dividend. And this provision is made effective with effect from 1st October 2024. So if a company does any kind of buyback, then earlier provisions will apply. If company does any kind of buyback after 1st October 2024, it will be considered as deemed dividend in the hands of the shareholders. More details will be discussed in assessment of various entity topics. Need not to worry, we do have a very solid example, and this is a topic that from which you can expect a question in your exam. So you have to be very serious in this topic. Got it, sir? Got it? Got it. What amendment in this chapter? What else amendments? Sir, family pension. Whenever family member of a deceased person used to receive family pension, they were allowed a deduction under section 57. How much deduction they were allowed? They were allowed deduction of 1/3 of family pension or 15,000 rupees per annum. Whichever is lower, they were allowed. 1/3 of the family pension or 15,000, whichever is lower, they were allowed as deduction under section 57. With effect from via Finance Act 2024, government changed this limit of 15,000 to 25,000. But only for SSCs opting for 115 BAC. What it says, if any kind of SSC opts for 115 BAC, then if he receives any kind of family pension, he will be allowed as deduction amounting to 1/3 of family pension or 25,000. That means this 25,000 limit is only applicable for those opting for 115 BAC. Minor amendment, not much relevant, but yet. Section 57, allowable deduction. What this point says. So you remember section 57 is all about expenditure that you can claim against IFRS income. It is all about expenditure that you can claim against IFRS income. What exactly section 57 says, if you remember, if you have any kind of dividend income, say for example 100 crore rupees you have dividend income, then normally you are not allowed any kind of expenditure on dividend income, but only one expenditure is allowed. If you have paid any kind of interest to earn such dividend income, if you have paid interest to earn such dividend income, then interest to the extent of 20% of dividend will be allowed. If you remember, interest paid to the extent of 20% of the dividend income will be allowed as deduction under section 57 against such dividend income. If you remember, this dividend can be final dividend. This dividend can be interim dividend. This dividend can be deemed dividend. Any kind of dividend income that you are offering in your other sources income can avail such deduction under section 57. That 20% is for everything, but with effect via Finance Act 2024, explicitly it is mentioned that no 20% no expenditure of 20% will be allowed against the dividend referred under section 222F. Now if you have any kind of dividend income which is taxable as buyback or taxable under section 222F, that means any kind of money you are receiving, on account of buyback, it will be considered as deemed dividend, but no 20% deduction will be allowed against such income. if you have paid any kind of interest to earn deemed dividend, which is taxable as by, if you have paid any kind of interest to earn any kind of deemed dividend which is taxable under section 222F. That means you have earned a dividend via buyback, then no deduction of interest will be allowed, no expenditure at all will be allowed against such dividend referred under section 222F, that is buyback. So in short, if I am asked to say any kind of dividend if you are receiving from buyback of securities, then you will never be allowed any kind of deduction. Any kind of consideration received on account of buyback will be dividend, and it will not, you cannot avail any deduction against such income. That is the bottom line. Section 58 says something that no expenditure will be allowed against any income. No expenditure is allowed for any income referred under Section 222F. That means if you are having any kind of buyback income, if you are having any kind of deemed dividend, which is on account of buyback of securities, then no deduction will be allowed against such income. Simple point. That's all about IFRS. Let us start the amendments that are in PGBP chapter. Majorly, there are three amendments. Rest you can ignore. Only three amendments are there in PGBP chapter. First of all, an explanation has been added to section number 28. What this explanation says: if a person has business of letting out of immovable property, a person has business of letting out of immovable property, he can let out two kinds of property. He can let out two kinds of property. It can be either commercial property, it can be residential property, residential house property. Provision says if your business is letting out of property, then rental income should be your business income. Rental income should be your business income, because if it is my business to rent out any property, so rental income should be business income now. Provision says yes, it should be business income. Any kind of commercial rent that you are receiving, any kind of commercial property you are letting out, and any rent received from such property shall be considered as PGBP only. Yes, yes, yes. But if you are letting out any kind of residential house property and your business is letting out businesses of letting out such properties, then earlier you used to offer such income under business income. Earlier you were taxing such income from rent under that PGBP, but now this explanation clearly states that any kind of income from house property will always be taxable under income from house property. Any kind of any kind of rental income that you receive from residential house property, it will always be taxable under income from house property, irrespective of the fact that whether you do business of letting out of property or not. Sir, it will always be taxable under income from house property only. That is the bottom line of this amendment is. Earlier, people used to offer such income under that PGBP, claim multiple deductions, claim multiple exemptions, claim multiple expenditures, and offer very little income in the business side. But government has clearly stated we don't want to make any dispute. We just want this income to be offered against income from house property. That is it. Any kind of income from renting of house property, residential house property, will always be house property income. That is the bottom line of this amendment. Second amendment. Whenever any employer contributes any sum to NPS scheme referred under section 80 CCD, what it says, sir, employer can contribute any sum to national pension scheme for his employees. For such expenditure, for such payment, he is allowed expenditure. How much expenditure he was allowed? He was allowed actual contribution, whatever contribution he does, or 10% of salary. 10% of salary he was allowed. Actual contribution or 10% of the salary he was allowed. Via Finance Act 2024, this 10% limit has been increased to 14%. Now, employer can contribute 14% of salary of the employee to NPS, and he will still be allowed as deduction. Normally, you used to have question where employer used to contribute 17%, 12%, 13%, and proportionately you used to disallow. You used to allow only 10% and rest you used to disallow. Now, in newer questions, you have to disallow any contribution exceeding 14%. Now, for example, if an employer contributes 17%, you just have to disallow 3% now. This is the amendment, and this will impact many questions. So there is greater possibility you might see this question being asked in your exam. You just have to be careful. So what this amendment says, any contribution made by the employer towards the NPS, he will be allowed deduction to the extent of 14% of the salary or actual contribution, whichever is lower. By salary, I mean salary and basic salary and earner's allowance, which form part of retirement benefit. That's it. Next amendment. Next amendment, very little amendment, very minor amendment, even not even like an amendment as such. Section 37 says if you are paying any sum to settle any proceedings which is in contravention to any act. For example, I have proceedings going on against me. For example, against COFEPS Act, Foreign Exchange Smuggling Protection Act, any kind of COFEPS Act, or any kind of such act which is against which I am against which any legal proceedings are pending against me, and I'm asked to pay certain sum to just drop the proceedings. Any kind of payment that is being made by me to settle the proceedings, which is in contravention to any act other than Income Tax Act, will be disallowed. Will be completely disallowed. You don't need to remember. You automatically would have disallowed if you would have seen that point. Need not to take care of that point too much. Any amendment as such in this chapter? No, I don't think any other amendment. No, sir, no other amendment. No amendment in ICDS. Meanwhile, you can like the video now. You can like the video. If you have watched this far, you can like the video. No amendment in clubbing topic. No amendment in set off. Deductions chapter. Do you really think deductions can have amendment? Do you really think deductions can have amendment? Yes, deduction can have amendment. What this provision says. Remember, right now we have studied that whenever any employer contributes to NPS for employees, then employer is allowed deduction to the extent of 14% of the salary. Now, since employer claims the deduction, this salary should be taxable in the hands of employees. Yes, it should be taxable in the hands of employees. Employer claims the deduction, it should be taxable for employees. Yes, it should be taxable and it is taxable. Employee is allowed deduction under section 80 CCD2. Employee is allowed deduction against such income that is being contributed by his employer against such NPS scheme. He is allowed deduction under section 80 CC2. And how much deduction is allowed? Do you remember? So normally he was allowed deduction at the rate 10% of salary or actual contribution, employer contribution, whichever is lower, he was allowed. Now, since this limit of 10% has been increased to 14%, don't you think government would have changed the deduction limit also to 14%? Right answer is government has changed this limit, but the government has changed limit only for SSC opting for 115 PA. That means what conclusion we can draw from this is, if you are opting for 115 BAC, you will still be allowed deduction under section 80 CCD2. That is, whatever contribution your employer makes to NPS, you will be first taxable. You will be first taxed such income, and then you will be allowed deduction on such income. How much deduction you will be getting? If you are opting for 115 BAC, then 14% of the salary or actual contribution, whichever is lower. But if you are opting for regular regime, 10% of the salary or actual contribution, whichever is lower. But if you are a government employee, you are already allowed 14%. So there is no change in the deduction for employees who are working under government. There is no change per se. For those who are opting 115 BAC will be allowed deduction at the rate 14% of the salary. That is the amendment. Regular employee 10% of actual contribution, 115 BAC 14% of actual contribution, whichever is low. That is the minor amendment. We not to worry much about that. What else amendment you can see? What else amendment you can see in this chapter? Oh my God, sir! No amendment in this chapter. No amendment in this chapter. Perfectly fine. Beautiful, beautiful, beautiful. Next chapter, assessment of various entities. Sir, minor amendments in this chapter, but that are very important, very critical for your examination. First of all, firm taxation. In firm taxation, whatever capital gain that individual used to have, or whatever tax rates which were changed for individual, similarly will be changed for firm only. So, for example, if a firm used to have any kind of long-term capital gain under section 112, earlier firm was taxed at the rate 20%, but after budget tax rate was reduced to 12.5%. Earlier firm used to get indexation, but now firm will not get indexation. 112 earlier it was taxable. Earlier it was taxable before budget it was taxable at the rate 10% over and above 1.25 lakh rupees. But after budget tax rate has been increased to 12.5% over and above 1.25 lakh rupees. And STCG triple one, earlier before budget it was taxable at the rate 15%. After that it was taxable at the rate 20%. This is a very logical amendment that has come in capital gain. It will impact the firm taxation also. What change or what other change that has come? So that is allowability of remuneration. Whatever remuneration that a partnership firm pays to any kind of partner, whatever remuneration that firm pays to partner. Earlier, what used to happen, if you remember, Sir, we used to calculate the book profit for partnership firm. We used to calculate book profit. Book profit, what book profit was? It is nothing but, sir, PGBP before remuneration. PGBP before remuneration. We used to calculate book profit. And out of this book profit of first 3 lakh, we were allowed remuneration of 1.5 lakh rupees or 90% of book profit, whichever is lower. And for balance book profit, we were allowed 60%. But now so things have changed in this topic. Now we have to calculate book profit. Book profit. Now what you have to do is, in this book profit, first you have to consider 6 lakhs. And of this 6 lakh, either you have to take 3 lakh rupees or 90% of the 6 lakh or 90% of the 6 lakh. What you have to consider later on, first 6 lakh, you have to take 3 lakh or 90%, and balance book profit you have to take 60%. That means earlier this limit was up to 3 lakh rupees, 3 lakh 90%, 1.5 lakh, whichever is lower, whichever is higher, and balance was 60%. But now this 3 lakh has been increased to 6 lakh rupees, and minimum remuneration, which was 1.5 lakh, has been increased to 3 lakh. What change it has brought? Just understand this point. What change this has brought? For example, if a partnership firm has book profit of 9 lakh rupees, what earlier remuneration it used to partner it was allowed? For first 3 lakh rupees, it was 1.5 lakh or 2.7 lakh, which is equals to 90%. You understand this point. And balance 6 lakh, we used to get 60%, which was 3 lakh 60,000. So total remuneration which was allowable was 2.7 plus 3.6. That is 6.3. But now what people will get is up to 6 lakh rupees. So 3 lakh or 90%, that is 5.4 lakh, and balance 3 lakh will be 60%, that will be 1.8 lakh. In total, if we make 5.4 plus 1.8, in total 7.2 lakh will be allowed as deduction as remuneration to such partnership firm. Did you get this point or not? So higher remuneration is allowed. Higher remuneration is allowed as per this amendment. What amendments? No other amendments in partnership firm. The AOP taxation. If you remember AOP taxation, there were two minor things. Two minor things. First of all, earlier we used to tax AOP at the rate MMR when share of profit, share of members was not known, or if it was known, any of the members' gross or net total income exceeds basic exemption limit. In these two cases, we used to tax AOP as AOP as at the rate MMR. We used to tax that. Whatever MMR was, sir, MMR was 30%. Just give me a second. MMR was 30%, 37% surcharge, plus 4% education cess. Now, what provision says is, if AOP pays tax under 115 BAC, then this 37% surcharge should not apply now. Because since AOP MMR is maximum marginal rate now. So for a SSC opting for 115 BAC, we do not have any kind of 35% surcharge bracket. So MMR should be 30% plus 25% plus 4%. 30% plus 25% plus 4%, which equals to 39% will be MMR, which is equals to 39% of the MMR. How can you remember this MMR rate? In Hindi, we used to say 3 3 4 3 3 4 aisa. We used to learn this way. 3 3 4 3 3 4. 3 means 30, 3 means 37, or 4 means 4. 3 3 4 3 3 4. You can remember this. 3 3 4 3 3 4 3 3 4. 3 implies 30%, 3 implies 37%, and 4 implies 4%. By this way, you can learn this MMR rate. Also, for 3, instead of 3, you can use 2.5, which implies 25% of the surcharge for 115 BAC. That's all. You can learn this. It is not simple. It is not difficult as you think. No issue with this point. No other issue with this point. What amendments do we have in this topic? What amendments do we have in this topic? Yes, buyback. The buyback. We have read this topic in IFOS, that whatever income, whatever money that shareholder receive on account of buyback shall be considered as deemed dividend. Whatever money that shareholder receive on account of buyback shall be considered as deemed dividend. Yes, sir, it is considered. What earlier taxation was? What earlier taxation was? So 30th September 2024, whenever a domestic company used to do buyback, sir, it was exempt in the hands of shareholders under Section 1034A. Whenever a domestic company does any kind of buyback, for example, Reliance does buyback and I have shares, then whatever money I will be receiving or company was completely exempt. No capital gain used to arise in this case. But in the hands of the company was liable to pay taxes on such distributed income. Company was liable to tax at the rate 20% plus 12% surcharge and 4% education cess. Company was liable to pay tax at the rate nearly 23.296%. Company used to pay tax at the rate this percent at this percent. Company was taxed on distributed income. This was so the case before 30th September 2024. And for foreign company, whenever a foreign company does any kind of buyback, company was not taxed, but shareholder were taxed, and they were taxed under that capital gain. This was so the case. That means in case of domestic company, onus was upon the company to pay taxes on distributed income, and in case of foreign company, onus was upon the shareholders to pay capital gain taxes. There was very kind of different approach for different kind of buybacks. Just to streamline this process, government made a major amendment. What amendment did it say? Any consideration received by the shareholders on account of buyback shall be only taxable under the head 222F. No taxability under any head will be allowed. No taxability under any head will be allowed in case of foreign company, in case of domestic company, we do not care. With effect from 1st October 2024, any buyback money that you receive will be taxable under the head income from other sources as deemed dividend. Just understand this example. For example, Rahul has 1,000 shares of Reliance, which I bought at the rate 2,000 rupees. What investment did I make, sir? 2 lakh rupees investment I made on 1st April 2024. Company proposed a buyback on 1st November 2024. That is after budget. Since it is doing buyback after budget, then whatever money that I will be receiving will be considered as deemed dividend. So what money I am receiving, sir? 2,500 rupees is the buyback price. What number of shares that I had is 100. Amount that I will be receiving, it will be 2,50,000 rupees. Provision says whatever the amount that I am receiving will be considered as deemed dividend. I am receiving 2.5 lakh rupees. Just think, my dear friends, 2.5 lakh, whatever I am receiving will be taxable under the head income from other sources. No other point, it says. No other points. That means whatever cost of acquisition that I've incurred is disregarded. Whatever cost of acquisition that I've incurred is disregarded. Any money received by me will be considered as deemed income. Just imagine. I have profit of only 50,000 rupees, but 2.5 lakh rupees is being taxed in my hands. That is so the case. So 2.5 lakh will be taxable. But sir, what will happen? What to do about the investment that I have made? Cost of acquisition. Why it is disregarded? Provision says don't worry. What provision says? For the purpose of capital gain, now just calculate capital gain as it was. Just assume that capital gain has also occurred in your hands and take full value consideration as nil and take cost of acquisition as original cost of acquisition. So in this case, whatever the cost of acquisition that you used to have will be capital loss in your hands. That means whenever now buyback will happen, you will have two treatments. Whatever the money you are receiving will be considered as deemed dividend, and whatever the losses you are incurring will be carried forward. It can be set off against the either long-term capital gains or short-term capital gains. Whatever the capital loss you have, it will be carried forward or it can be used to set off against any income. This means for any kind of buyback that occurs after 1st October 2024 will have dual impacts. Money received will be considered as deemed dividend. Whatever money I am receiving will be considered as deemed dividend. And whatever the cost of acquisition of such shares, such securities I have paid will be considered as capital loss for me. Whatever cost of acquisition that I have paid will be it will be capital loss to me because sales consideration is treated as nil. And what will happen to this loss? I can carry forward it as per my set off and carry forward provisions. This is the simple change that buyback has proposed. It's a business trust. In case of business trust, what amendments this topic has brought? So this topic has brought amendment in case of business trust, period of holding of business trust. Earlier, whenever we used to have the units of business trust, we used to hold it for 3 years to make it long term. We have studied this in capital gain also, that whenever we used to hold business units of business trust for 3 years or more, then it was long term, otherwise it was short term. With effect from via Finance Act 2024, with effect from 23rd July 2024. Now, if you hold any kind of units of business trust, you just have to check period of holding for 1 year. If you hold it for 1 year, then it will be long term, otherwise it will be short term. This is the major change that it has brought. How taxation will change, just understand this. Before 23rd July 2024, if you hold business units of business trust for 36 months, then you were taxed at the rate 10% in excess of 1.25 lakh rupees. But before that, if you sell before for holding less than 36 months, you were taxed at the rate 15% under section 112A if units were listed, with effect from 23rd July 2024. Now, period of holding has been changed to 12 months. Now, if you hold such units for more than 12 months, you will be taxed at the rate, sir, 12.5% in excess of 1.25. This 1.25 lakh limit is same, but since budget date has lapsed, so tax rate will increase and you will be taxed at the rate 12.5% since units are listed now to 12.5%. And short-term capital gain will be 20% under section 111A. This is case for the business trust units that are listed on recognized stock exchange. What if, sir, units are not listed? Then what will happen? Sir, earlier we used to have 20% LTCG. Now this will change to 12.5%. And for normal STCG remains the same. Normal STCG remains the same. Before budget, after budget, will remain the same. So this is the major amendment that has come in business trust topic. Before budget, you have to check different period of holding. After budget, you have to check different period of holding. Before budget, you have to apply different tax rate for securities that are listed. After budget, you have to apply different tax rates for securities that are listed. What else amendment you can find in this chapter? No amendment, sir. No amendment. Oh my God, sir. Oh my God. No amendment in this chapter. Now come to next chapter, that is taxation of trust. Does this chapter have any major amendments? Right answer is I don't think such amendments are major, but yes, there are amendments. First of all, registration process. Registration process of a charitable trust. Sir, trust used to get itself registered under section 12AB. If you remember, 12AB. Trust is required to get itself registered under section 12AB. There were six possible case scenarios in which trust used to get registered. First of all, whenever it was registered under previous provisions, now it has to get itself registered in newer provision. This was so the first case. For the first time, if you are applying for registration, you have to get provisional registration. Third case was when you used to convert your provisional registration to final registration. This was the third case. Fourth case, in case of renewal, you have already opted for 112AB. After 5 years, you have to opt for renewal. Fifth case was whenever you opt for any kind of modification, and sixth case was whenever your trust becomes inoperative, you have to apply for registration. These were six cases in which trust was required to apply for registration. Now, due dates have changed in this case. Only a bit, only a bit. What used to happen is just remember this point. So whenever provisional registration was tried to be was sorted to convert to final registration, whenever a trust used to finalize its registration, trust was already registered as trust has already received a provisional registration. Now it intends to convert such provisional registration into final registration. Trust intends to convert. What was the time limit for application? Provision says either you have to make application within 6 months from the commencement of the activities, either you commence or your activities and apply for final registration within 6 months, or let 6 months let the time period for such provisional registration lapse, and 6 months prior to such expiry of time period you have to apply. Whichever date comes earlier, you have to apply for final registration. This was so the case. You have to either apply 6 months from the commencement or 6 months prior to expiry of provisional registration, whichever is earlier. 6 months from the commencement or 6 months prior to the expiry, whichever is earlier, you used to apply for final registration. This was so the case. And assessing officer, or not assessing officer, but CIT and PCIT were forced to give you final registration within 6 months from end of month in which application is received. But this month word has been changed to quarter. Now, CIT, PCIT will not give registration within end 6 months from the end of the month. They will give final registration within 6 months from the end of the quarter of application. What earlier provision was? CIT, PCIT used to give final registration within 6 months from the end of the month of registration, month of application. But now this month word has been substituted to quarter. So whenever you are making application, let that quarter end, and from that quarter end, you have to consider 6 months. Let us understand this with an example. This example will clarify things a lot. For example, for previous year 24-25, trust got provisional registration on 1/10/2024. Now this provisional registration will be applicable for previous year 24-25, 25-26, 26-27. Trust commenced its activity on 1st January 2026. So first day to apply, last day to apply for final registration is 6 months from the commencement of the activities. So trust commenced its activity on 1st January 2026. So it has to apply for final registration within so 31st June 2026. This is the final date. This is the first final date. Or 6 months prior to expiry of provisional registration. Provisional registration will expire on 31st March 2027. 6 months prior to that, trust has to apply. What is the 6 months prior date? So 30th September 2026. Earlier of these two dates, trust should apply for final registration. For example, trust made application on so 25th May did the application. 25th May 2026, it made application. 26th May it made application. Now, what provision says earlier? Provision was let the month end, and from the end of the month, AO was required or CIT PCIT was required to give final decision within 6 months. But now you don't have to wait for month end, you have to wait for quarter end. When will quarter end? Quarter will end on 30th June. Quarter will end on 30th June. And from that quarter end, you have to consider 6 months. So CIT PCIT will give registration up to 31st December. Earlier, you used to wait for month end and 6 months. Now you have to wait for quarter end and 6 months. That is the bottom line. And this has not just changed for one case, this has changed for three cases. What the provision has changed? Whenever you used to get the renewal for registration, you are already registered under section 12AB. Your 5 years are about to be finished, and you want to renew your registration. Then you were required to make application 6 months prior to the end of expiry of registration. You were required to apply 6 months prior to expiry. And you used to get the registration from the end of the month. You used to get the registration from the end of the month of the application, 6 months from the end of the month of application. But now 6 months from the end of the month has been substituted to 6 months from the end of the quarter. And third thing is, whenever trust has made any modifications in its objects, so it requires to make application. It is required to make application 30 days from date of modification. It is required to make application within 30 days from the date of the modification. And CIT PCIT is required to approve such application within 6 months from end of quarter. In these three cases, earlier we used to have 6 months from the end of the month, but now this has been substituted to 6 months from the end of the quarter. This is the major change. Rest in case of trust becomes inoperative, 6 months from the end of the month remains same. What used to happen is whenever any trust, if any kind of trust made any delay in submitting the application, CIT PCIT used to reject such delay. CIT PCIT never allowed any kind of condonation because of his trust faced many hardships in complying to provisions of this section. For that matter, this note has been inserted with effect from 1st October 2024. What this says, any kind of delay in application may be condoned by CIT PCIT if there is reasonable cause of failure. CIT PCIT has to condone delay if there is reasonable cause of failure. CIT PCIT cannot merely reject the application on the ground that it is late. If there is reasonable ground of failure, then CIT PCIT will condone such delay. Did you get this point or not? Did you or did you not get this point or not? Sir, we got this point. We got the bottom line. 1023C. So you remember, we used to have two regimes going side by side. First regime was 12AB. If a trust get registered under section 12AB, can avail benefit under section 11, 12. It can avail benefit like any kind of corpus donation will be exempt. Any kind of capital expenditure will be allowed as application. Any kind of application from corpus will be allowed in the year in which it is deposited back to corpus. There are multiple benefits given under section 12AB. And we used to have similar benefits under section 1023C. Sir, if we have any kind of school, any kind of hospital, any kind of government financed institution, any kind of other institution, sir, which gets registered under section 1023C, we used to have double regimes for similar benefits. Any institution willing to get registered under section 12AB can get registered under section 1023C, and vice versa is also true. If it is already registered under section 1023C, it can register itself under section 12AB and can claim benefit under either of the section, but not both. It can claim benefit under either of the section. Almost provisions under both the regimes were similar. So, government, with effect from 1st October 2024, wished to discontinue newer application under this section. Now, new SSC cannot apply under registration under section 1023C with effect from 1st October 2024. So this means when this scheme is revoked, na, this scheme is not revoked. This scheme is not revoked. We need to understand the essence of the scheme first. So this regime was applicable for three kind of SSCs. First of all, any SSC which was wholly or substantially financed by government. That means out of the total receipts, greater than 50% of the receipts are received from government. Those institutes, they were fully exempt. They were not required to get approval. They were not required to get registered. Second beneficiary of this scheme was any kind of school hospital whose aggregate turnover or aggregate gross receipts was up to 5 crore rupees. They were also not required to get registered, and they were also not required to get any kind of approval. And we had third category of institutions, other medical institutions which had turnover exceeding 5 crore, other institutions. So they were required application, they were required approval, they were required registration under 1023C. Now, since they have stopped giving any newer registration, sir, these kind of institutes that used to get registration under this section will not be allowed any fresh registration. What will happen to existing registrations? Sir, existing registrations will continue to happen. They will still be allowed exemption. Whenever their exemption will lapse, they will have to get themselves registered under section 12AB. They will have to get registered under the 12AB regime. What will happen to these two entities? Sir, if any entity has any turnover up to 5 crore rupees, or if it is government finance, it will continue now. They already don't require any kind of approval. Government has stopped giving any kind of new approvals in this scheme. Government has stopped giving any kind of new approval, but sir, they don't require approval, so they can continue to opt for this scheme. So this is only a minor amendment. You must be aware of this thing. This can be asked in your exam. I do think that these amendments are very crucial for your examination point of view. Any question can simply be asked from these points, and it definitely can create difficulty for you. Definitely can create difficulty. So for that matter, I really want you all to be very serious on these matters. But this point, sir, yes, sir, we did get this. TDS, TCS, advanced tax and refund. So normally we do not have any amendment in advanced tax. We do not have any amendment in refund topic. We do have amendment in TDS and TCS, and amendments are a bit major. What kind of amendments are major? So first of all, wherever we used to have 5% TDS rate now, that has been reduced to 2%. And that has been reduced with effect from 1st October 2024. This is the first thing. Like if you remember, we used to have 194 DA. Any kind of receipts that were received at the time of life insurance maturity. Any receipts that we used to get on the time of maturity of life insurance policy. If those proceeds were taxable, then we used to get TDS deducted at the rate 5%. We used to deduct TDS at the rate 5%. But with effect from 1st October 2024, that TDS rate has been reduced to 2%. At multiple places, this TDS rate has been reduced. You just need to study along with me. TDS rates are important. Why they are important? Because they have been reduced in mid of the year. They have been reduced in mid of the year. So for that matter, now provision can confuse you on dates. Okay. Salary, no amendment. 192A, 193, 194, 194A, no amendment as such. 194B, no amendment. BA, no amendment. C, no amendment. D, no amendment as such. DA. Whenever any insurance company pays any kind of maturity on LIP, life insurance policy, any kind of maturity if it pays, and such maturity is taxable and maturing amount is exceeding 2 lakh, then insurance company was required to deduct TDS at the rate 5% on amount exceeding the premium. On maturity amount exceeding the premium, whatever premium that it has collected, minus whatever the amount that it is paying, whatever the differential amount that it is paying in extra, was liable for TDS at the rate 5%, but the TDS of 5% was only applicable up to 30th September 2024. After that, company has to deduct TDS at the rate 2% only. But it's no amendment in 194E. 194G. Whenever any kind of lottery company used to pay any kind of lottery commission to its agent, or any person who pays lottery commission on lottery, then that person was required to deduct TDS at the rate 5%. That 5% has been reduced to 2% with effect from 1st October 2024. 194H. Sir, 194H, any kind of person whose turnover exceeds 1 crore or 50 lakh professional receipts or any kind of company proprietorship, any other SSC. We call such SSCs as hijacker SSCs. Any kind of SSC whose turnover is up to 1 crore, professional receipts are up to 50 lakh rupees. Except these SSC, every other SSC is required to reduce under section 194H, 194I, 194J, 194C, 194R. So under these provisions, these SSCs are required to deduct TDS. Like big SSCs, we used to call them hijacker SSCs. Now, if any hijacker SSC pays any kind of commission, he was required to deduct TDS on commission at the rate 5%. But this 5% is again changed to 2% with effect from 1st October 2024. Sir, what if dates are not given in our question? What if dates are not given? We are just given that commission is being paid to such and such person. What will happen? See, normally you will be given with dates. You will be given dates. But but for that matter, you just have to check. If nothing is given now, you just assume the newer rates. Because TDS is always prospective, you can simply assume that rate is 2% only if nothing is given. What all amendments have been made? So 194 IA. What 194 IA says, just listen to this. 194 IA. So what 194 IA says, whenever you buy any immovable property and either SDV of such property stamp duty value or purchase price of that property, either of thing exceeds 50 lakh rupees, then on higher amount, whatever the higher amount is, you have to deduct TDS at the rate 1%. That was so the case. That was so the case. That whenever either SDV or FMV, either SDV or consideration, whichever is higher exceeds 50 lakh, then you have to deduct a TDS at the rate 1% on the higher amount. That was so the case under section 194 IA. Buyer used to deduct TDS for this of the seller. What if, sir, me, Rahul, is buying a property along with my brother Mehul? Property's worth is 99 lakh rupees. I am paying 49.5 lakh rupees. Mehul is paying 49.5 lakh rupees. SDV of the property is 99 lakh rupees, which is divided into halves. Sir, consideration is less than 50 lakh rupees. Per buyer, consideration is less than 50 lakh rupees. Per buyer, SDV is less than 50 lakh rupees. So either buyer is not required to deduct TDS. This was so the case previously. This was so the case previously. But with effect from 1st October 2024, certain amendments have been made to this section. Earlier, what used to happen? We used to check 50 lakh limit per buyer wise. We used to check 50 limit per buyer wise. Like if buyer's consideration or SDV with respect to such buyer is up to 50 lakh, then buyer was not required to deduct TDS. But with effect from 1st October 2024, we have to check property wise. Like if property's SDV is exceeding 50 lakh, then we can have multiple buyers. So consideration of all the buyers have to be clubbed to find out the consideration applicable for TDS. In our case, since my consideration, Rahul's consideration was 49.5 lakh rupees, it was below limit. But Mehul's consideration was also below limit. For the matter of this section, you have to club the consideration of all the buyers and find out whether it exceeds 50 lakh or not. If it exceeds 50 lakh, then TDS is required to be deducted on whole amount at the rate 1%. Even though my consideration is lesser than 150 lakh rupees, I am required to deduct TDS. Because with effect from 1st October 2024, consideration from all the buyers is to be merged to find out the threshold limit. Minor amendment, but can be asked seriously in your exams. 194M, any kind of individual HUF that is not covered under section 194HCJ pays any kind of commission, contract, brokerage, professional services to any resident person exceeding 50 lakh rupees will deduct TDS at the rate 5% up to 9 September. And this 5% has been reduced to 2% with effect from 1st October 2024. Cash withdrawal, no amendments as such. 194O, you remember this 194O was all about online e-commerce operator. Whenever a seller used to sell any goods via e-commerce operator and any kind of payment has been made by the buyer to the e-commerce operator, while remitting such payment to the seller, e-commerce operator is required to deduct TDS at the rate 1% on such payments. E-commerce operator is required to deduct TDS at the rate 1% on such payments. This 1% limit has been reduced to 0.1% with effect from 1st October 2020. 1st October 2024, this is being reduced. Earlier, this limit was 1%, but this has been reduced to 0.1%. 194Q, no change. 194R, no change. 194S, no change. There is new section added, that is 194T. What this provision says? See, this provision is applicable with effect from 1st October 2025. So for your attempt, it is not applicable. It is not even given in module. But since it is given as a part of budget, it is given as a part of finance bill. I am incorporating this point in your amendment video also. There is no harm in reading extra. What this provision says, if any partnership firm pays any kind of interest, remuneration, sir, commission, or any money to partner, to individual partner, and such money exceeds 20,000 rupees per annum, then firm is required to deduct TDS at the rate 10%. Firm is required to deduct TDS at the rate 10%. And not just on amount exceeding 20,000 rupees, but on the whole amount firm has to deduct TDS if amount exceeds 20,000 rupees in financial year. In under section 194 B and C, we used to have earlier tax rate at the 10% on the capital gain, but this has been increased to 12.5%. Similarly, all the tax rates that were 10% has been increased to 12.5%. Everything that we have studied in capital gain has changed from 10 to 12.5% and 20 to 12.5%. It has changed. So everywhere wherever TDS implications were have been changed here itself accordingly. Section 201. So whenever you were required to deduct TDS and you did not deduct TDS, and you were required to pay on time but you did not pay on time, what used to happen was, sir, your expenditure was disallowed. Your expenditure was disallowed. But there was also a provision. Government can make you SSC in default. This government can make you SSC in default. And that order of making you SSC default can be passed within 6 years, within 7 years. Earlier the case was 7 years from end of year of payment or deduction, year of non-payment or deduction. Like for example, in previous year 24-25, you were liable to deduct TDS, but you did not deduct TDS. So from such end of such financial year, within 6 years, government can declare you SSC in default. Government can declare you SSC in default. Earlier, this provision was 7 years, but now this has been reduced to 6 years. Now that is, if you have forgot to deduct a TDS, then government can make you SSC in default up to 6 years from the end of non-deduction. This case with resident SSC, if you have forgot to deduct TDS or forgot to pay TDS, in case of any resident SSC, then 6 years limit will apply. But if you have not deducted TDS and if you have not paid the TDS, then in that case, sir, AO can pass order without any limit. There is no limit of 6 years, even if you deduct TDS. And after 50 years, AO realizes that you have not deducted TDS or you have not paid the TDS, then AO can call you. AO can declare you SSC in default even after 50 years. There is no time limit in case of non-resident TDS deduction. Simple provision, not difficult as such. What amendments are there in this topic? Mm, No amendments as such. Assessment procedure we will do later on. At last we will do. Meanwhile, you can like the topic now. Okay. Aadhaar number. What this provision says. Sir, whenever earlier what used to happen was whenever you never had any kind of Aadhaar number, so you were required to quote your Aadhaar enrollment ID in any kind of application. You were allowed to do so. But with effect from 1st October 2024, you have to replace your Aadhaar enrollment ID to by Aadhaar number. You are never allowed to quote Aadhaar enrollment ID anymore in any income tax forms. You have to compulsorily quote Aadhaar number. Government has given sufficient time to update your Aadhaar enrollment ID with Aadhaar. With effect from 1st October, you have to compulsorily quote Aadhaar number wherever you are required to quote Aadhaar. You cannot quote any enrollment ID again. The search assessment case, we'll study about it later on. We'll study about this later on in detail. At last, we'll study. In case of appeals and revisions, what changes that government has brought in appeal? What it says earlier. What used to happen was whenever we were aggrieved by the order of CIT appeals or Joint Commission appeals, we could go to ITAT, and time limit for going to ITAT was 60 days. What provision have changed with effect from 1st October 2024? Now you can go to ITAT not in 60 days, but within 2 months from end of month of order. Now 2 months, 60 days limit have scrapped. Earlier, what used to happen was 60 days from the date of the order. But now things have changed. Things have changed to 2 months from the end of the month of the order. You can go to ITAT with effect from 1st October 2024. Another changes that has come in appeals topic. So there was comparison sheet between powers of CIT appeals, Joint Commissioner appeals, and ITAT. One major power was power to refer, power to set aside and refer back AO for fresh assessment. Whenever ITAT did not like any kind of assessment done by the assessing officer, ITAT had powers to refer back AO for fresh assessment. ITAT can ask assessing officer to do the fresh assessment again. This was the power with the ITT, but this was not the power with SITA, or SITA, I should say, CIT appeals. This was not the powers with CIT appeals. CIT appeals cannot ask assessing officer to do the fresh assessment again. But with effect from 1st October 2024, this power has been amended. Now, CIT appeals or Joint Commissioner appeals can ask assessing officer to do fresh assessment, but only if it pertains to order under section 144. That means if order is regarding to best judgment assessment. If assessee has come to CIT appeals or Joint Commissioner appeals against the order that has been passed under section 144, that means that order is that order is against the best judgment assessment. Then in that case, CIT appeals or Joint Commissioner appeals can ask assessing officer to do the fresh assessment again. This is the minor amendment. With effect from 1st October 2024, CIT appeals and Joint Commissioner appeals can refer back to assessing officer for fresh assessment in case of appeal is against under section 144. CIT appeals and ITAT appeals, CIT appeals and Joint Commissioner appeals can also refer back to AO, but only if the case pertains to section 144. Appeal to High Court, no amendment as such. No amendments as such. GRC, no amendments. Penalties, no amendments as such. Miscellaneous provisions, no amendments as such. Tax audit. Hmm. Tax audit mein we do have a minor amendment. Clause number 29 is omitted now. Clause number 29 is omitted. What was clause 29? What used to happen is till last year we used to have a concept called angel tax. If it is still there in your IFOS topic, you can still strike it down. Whenever a closely held company used to issue shares much above its fair market value, then whatever the higher price, whatever the higher money that it used to get, it was liable for taxes under section 56 to 7. 7B, I guess it was. It was angel tax. It was tax for startups, which used to get very high premium valuation. Government used to tax such issue prices. This was abolished. This angel tax was abolished with effect from 1st October 2024. So you don't need to study this point at all in your Finance Act. In your for your examination, this point is not applicable. Angel tax is not applicable at all. For that matter, whatever reporting requirements was there regarding angel tax in tax audit report has also been removed. So clause number 29 has been removed accordingly from your syllabus. What else amendments we do have? Black money laws, are no amendments as such. There is minor amendment in this case. Certain penalties and prosecutions. Remember, sir, whenever we used to have any kind of undisclosed foreign income or foreign assets, when when such income comes to the notice of the AO used to penalize it with 30% taxes and 90% of penalty, 90% of 90% of the taxes, or I should say simply 30% of the taxes and 300%, 300, or I should say three times of taxes was penalty. Taxes were 3% and penalty was three times of the taxes. This was so the case. If AO finds out any undisclosed income or undisclosed foreign asset, they used to find this. Provision says if AO has found out any kind of undisclosed foreign assets, then no penalty shall be levied or leviable if failure is on account of undisclosed foreign asset up to 20 lakh rupees with effect from 1st October 2020. Like if you have bought any Facebook shares, it is up to 20 lakh rupees. If it is up to 10 lakh rupees, then no penalty will be leviable. Penalty will not be leviable. Tax will still be leviable. penalty will not be leviable. But this provision is not applicable for immovable property. Just remember, you can see an MCQ in your exam in which you are required to calculate the penalty, and in that case immovable property is also given in that question. You just have to ensure that you will still be penalized for having any immovable property outside India. You can have any undisclosed foreign asset up to 20 lakh rupees, you will still not be levied any penalty. But if you have any immovable property, you will be levied penalty. So this exemption is for every undisclosed foreign asset, but not for immovable property. In short, if you have any undisclosed foreign asset up to 20 lakh rupees, you will not be levied any penalty. But in case of any immovable property you have, you will be levied penalty. What is the penalty amount? Three times of the taxes. What amendments are there in non-resident taxation? Not major amendments as such, not major amendments as such, or I should say no amendments as such, but tax rates have changed. Come to the topic tax rates. Okay, yes. One thing has changed is, remember 44B? What 44B used to say? Whenever we have a shipping company, shipping company can pay 7.5% of the specified sum as their presumptive income under section 44B. What was the specified sum? Whatever the freight that it receives in India, and whatever freights that it receives from Indian person outside India anywhere. Whatever ships that come to India and freight is received in India, that will be specified sum. And whatever the cargo or goods that are taken outside from India and are being received anywhere in the world will be considered as Indian income. These two were specified sum, and of this specified sum, 7.5% was the presumptive income. Of these specified sum, 7.5% was the presumptive income. This provision was applicable for shipping companies, but now, with effect or via Finance Act 2024, government made an amendment and wrote a word other than cruise shipping company. That means they have excluded the scope of cruise shipping companies from this topic. Now, cruise shipping companies are not covered under Section 44B, and they have been included in another section called 44BBC, which talks about PGBP of cruise shipping companies. Simply, it says any kind of money that cruise shipping company receives, any kind of money that cruise shipping company either receives or anybody else receives on behalf of cruise shipping company will be taxed at the rate. Will be. Not tax actually. Cruise shipping company will have to declare 20% of such sum as presumptive income. 20% of such sum they have to declare as presumptive income. Sir, do they have any option of declaring lower? No, they do not have any option of declaring lower. This provision is applicable for non-resident cruise shipping companies. Whatever sum they are receiving or anybody is receiving on their behalf. Any resident is paying or any other person is paying to such cruise shipping company on their behalf. So all these sums will be included in the limit of specified sum, and of this specified sum, that cruise shipping company is required to pay 20% of the cruise shipping company is required to offer 20% as income, and correspondingly taxes have to be paid on such income. What else amendments have been made? Yes, sir. In case of NRI taxation, do you remember NRI taxation? Whenever a non-resident Indian has any kind of forex assets in India, so any kind of long-term capital gain on such forex asset was taxable at the rate 10%. So no benefit of 1.25 lakh was allowed against such forex assets. No benefit of 1.25 lakh was allowed against such capital gain. So provision says this 10 lakh, this 10% has been increased to 12.5% with effect from 1st October 2000, 23rd July 2024. All the tax rates have changed from 23rd July only. What the provision says: if any NRI sales any kind of forex asset, it would have been taxed at the rate 10%. After that, 23rd July 2024, and thereafter it will be taxed at the rate 12.5%. No major amendment. You would have done it yourself only. What else amendments? In case of specified fund and FII taxation, what changes have been made? Sir, any kind of LTCG that FII makes FII sales under section 112A, earlier it was taxable at the rate 10% in excess of 1.25 lakh rupees. Now it will be taxable at the rate 12.5% in excess of 1.25 lakh rupees. Other LTCG, so earlier 10%, now also it will be 10%. STCG, short-term capital gain. If any FII makes any kind of capital gain under section 111A, earlier it was 15%. Now it is being increased to 20%. Other STCG earlier it was 30%, now also it will be 30%. So these are the minor changes that have come in FI taxation. I don't think there is other. Yes, yes. Any kind of long-term capital gain income on overseas financial organization. Earlier it was 10%, now it is increased to 12.5% with effect from 23rd July. Similarly for GDR, earlier bond GDR, but capital gain on bond GDR was taxable at the 10%, but it has been increased to 12.5% with effect from 23rd July. So you must remember that any bond GDR sold by non-resident to non-resident outside India is not taxable. Any bond GDR sold by non-resident to person located in IFSC is not taxable. We are talking about bond in GDR. If non-resident sales to any resident person, then only this tax rate will apply. Otherwise, every other transaction is exempt. Every other transaction is exempt. Tax rate is 10% up to 23rd July, and after that it is 12.5%. What else changes are there in? No, sir, there are no other changes in NR taxation. TDAA, no amendments. Transfer pricing. Actually, we do not have any amendment as such in this topic, but in case of reference to TPO, remember what is reference to TPO? Reference to transfer pricing officer. Whenever assessing officer finds out any complex calculation in determining the value of arm's length price, then in that case he can refer such case to assessing of transfer pricing officer. During the course of the proceedings, if transfer pricing officers finds any other international transaction that is that has not been disclosed in the financial statement or that has not come to the notice of the assessing officer, he can consider such transactions also. In Finance Act 2024, government changed this point and says if TPO finds out if TPO if TPO finds out any international transaction, any concealed international transaction or specified domestic transaction, now even if TPO finds out any kind of specified domestic transaction, he can increase his scope to such specified domestic transaction also. Earlier, people used to object that specified domestic transactions are not covered within the scope of the TPO. With effect from via this Finance Act, government has increased the scope of TPO. Now, TPO, if TPO if finds out any kind of international transaction or specified domestic transaction, he can increase his scope and shall consider such transactions also. Very minor amendment, not major. Very minor amendment. If you ask me any other amendment, I don't think there is as such in this chapter. I don't think there is. No. Equalization levy. Yes, equalization levy. In equalization levy, we have a minor amendment. Do you remember we used to have two kinds of equalization levy? First equalization levy was equalization levy under section 165. If you take any kind of advertisement services from a non-resident, you were required to deduct TDS equalization levy at that 6%. It was as good as TDS now. It was as good as TDS. So I can call it TDS only. Okay. We used to have section 165 equalization levy, which was about e-commerce operator. If there was any e-commerce operator, non-resident non-resident e-commerce operator, if he sells any kind of goods in India, or if he facilitates any kind of goods in India, if he facilitates any sales, or if somebody pays to him to show any ads in India, then this e-commerce operator was required to pay 2% as income tax. Oh, sorry, 2% as equalization levy. 2% as equalization levy in India. Now this equalization levy has been scrapped. This equalization levy has been scrapped. And this equalization levy has been scrapped from 1st August 2024. This has been scrapped from 1st October August 2024. But you are very much lucky that ICA has not even included this topic in study material. So you don't need to study this at all. So if you have any kind of equalization levy in your book, you can simply strike it down. That is not relevant for your examination. Any amendment in advance ruling? No, sir, no amendment as such. Any kind of amendment in base erosion, profit shifting? No, sir, no amendments as such. Any kind of amendment in this uh, model tax conventions, tax treaties? No amendments as such. So continuing further with amendments in income escaping assessment or ultimately assessment procedure. In this Finance Act, the major amendment that has come is in income escaping assessment. And that too not just major, what has changed is it has changed assessment procedure for search cases. The cases of raid, the cases of requisition, it has changed substantially. And that too change has been made in mid of the year. So we need to understand line by line how income escaping assessment previously was and how it has been changed to now. For that matter, I have made a comparison sheet that will help you out to understand this provision way better. So earlier income escaping assessment procedures were applicable up to previous provisions are applicable up to first September 2024, and with effect from 1st October to 1st September 2024, newer provisions will apply. What are older provisions? They will help us out to understand the newer provisions in a better way. So we are trying to understand older provisions first, and with that, on contrasting nature, we will understand the newer provisions. First of all, sir, whenever government wants to do any kind of income keeping assessment on us, AO is required to serve a show cause notice to us. Show cause notice under section 148A. 148A, AO is required to serve a show cause notice to us. Simple provision. Why income escaping assessment should not be done against us? We have to reply against that show cause notice. That show cause notice has to be served first. Why income escaping assessment should not be done against us? That notice is called notice under section 148A, or income or show cause notice. Simply show cause notice, notice under section 148A. Whenever AO wants to send this notice, sir, it has to have certain information, and prior approval is required to send any such notice. To send such show cause notice, AO is required prior approval. From whom he can take prior approval? Sir, normally prior approval is required from two parties. Just listen to this. Huh? If case exceeds, if income escaped exceeds 50 lakh rupees, then approval was required from PCCIT or CCCIT. Or if income escaped is lesser than 50 lakh rupees, then approval was required from PCIT or CIT. These were the big income tax authorities from which approval was required by AO to do income escaping assessment, just to send the show cause notice. Show cause notice once issued, assessee has to furnish response within 30 days to 70 days. Minimum 7 days, maximum 30 days. Assessee has to furnish response. Based on the facts and assessee's response, AO will pass an order under section 148A that this case has been selected under section 148. That this case has been selected for income escaping assessment. Based on this fact, the AO will pass order that this case has been selected. So till far, what we have done is AO has just sent us a show cause notice and selected this case for income escaping assessment under section 148, 147 income escaping assessment. Our case has been selected. To continue further, AO has to send a notice. AO has to send a notice under section 148 that your case has been selected for income escaping assessment. You have to file a return. You just have to, AO has to send two things. So notice that your case has been selected, and you have to file a return. This notice is being sent under section 148. So what is the process? 148A, show cause notice. Once show cause notice is complied with, AO has to comply with 148, that is regular notice, and we are asked to return. We are asked to file the return. How much time is given to us to file the return? It is 3 months from the end of the month. We are given notice and requested to file return from the end of that month. In 3 months, we have to file the return. This is so the case. Before issuing notice under this section 148, AO was required to have information. AO must have information that income has escaped assessment. AO cannot select income escaping assessment. AO cannot do income escaping assessment on arbitrary basis, on ad hoc basis. AO has to have information, and these eight instances suggest that income has escaped assessment. These eight instances suggest AO that income has escaped assessment. What are the 8 cases? Sir, for example, risk management strategy of CBT told assessing officer that this person has income escaped. This person has income that has escaped assessment. For example, risk management strategy of CBT told that Rahul has sold a property and he has not declared it to income tax. In that case, AO has information. In case of audit objection, sir, what audit objection is? For example, department is under audit. For example, sometimes department is also under audit, and during that audit, auditor finds out that department has not done something correct, or department finds out that assessee's income has escaped. In that case, sir, AO has information. Because of court order, AO assessing officer finds out that income has escaped, so in that case he is deemed to have information. When information regarding Rahul has been received from other countries, for example DTAA, USA informs India that income of Rahul has been kept in USA. In that matter, it is assumed that AO has information. Under section 135, a faceless collection of information. Information of Rahul has been collected facelessly from different ways. So in case search has occurred at Rahul's space, search has occurred. So it is deemed I have AO has information. If search has already occurred held at my premises, AO must have information now. So search In such cases, it is assumed that AO has information. In case of survey, whenever survey occurs at my place, AO is presumed to have information. And in case of other party search, for example, I have a friend Mehul, and search happened at the premises of Mehul, and assets of mine are found there, books of mine are found there, then it is considered as other party search. In that case also, it is presumed that AO has information. So AO must have had information. Must have had information. AO must have had information, and he must have complied section 148A. He can simply send the notice under section 148. AO have notice and he have complied 148A. He can simply send the notice. What I am saying, AO has information, AO has information, AO has information, and he complied with 148A. He can send the notice under section 148. And as once notice is served, there is give and take of information. Assessee furnishes information. AO asks for more information. Assessee again furnishes the information. AO again asks for information, and this process continues. And an order under section 147 is passed. This is simple case. This is simple case. Show cause notice is sent. Then regular notice is sent. Regular notice can only be sent if two conditions are fulfilled. First of all, AO has information and AO has complied with show cause notice. AO has information. 8 instances suggest that AO has information. Now we have 3 exceptions to this point. Whenever there happens a search at my place, then AO is not required to serve any show cause notice. Then AO is not required to serve any show cause notice. It is obvious now, if search has occurred, then AO doesn't need to serve me any show cause notice that why income escaping assessment should not be done. AO doesn't require to serve any show cause notice. It is obvious. In case of search at my premises, in case of requisition, in case of other party search, or in case of section 135, for example, somebody other premises or premises of any other assessee is under search and my information is being found at that place, then AO is not required to send any show cause notice. Or my information has been collected by assessing officer via faceless collection of information. In that case, AO is not required to send any show cause notice to me. But if AO is not required to send any show cause notice to me, then for sending a notice under section 148, he has to take prior approval. He has to take prior approval. So what we have studied only 3 things. We have studied only 3 things. First of all, show cause notice is to be sent. Show cause notice is to be sent under section 148A. Second thing, notice has to be sent under section 148 and return is to be filed consequent to that notice. To send a notice under section 148, 2 conditions have to be complied by the assessing officer. First of all, AO must have information or he has complied with 148 and 148A. He must have complied with show cause notice. In 3 cases, show cause notice is not applicable. In cases where show cause notice is not applicable, he has to take prior approval. And once he takes prior approval, he can simply send the notice under section 148. He can simply send the notice under section 148. This was so the case before amendment. This was the case before the amendment. Amendment proposed certain changes with effect from 1st September 2024. All the search cases, requisition cases, other party case, search cases have been removed from this procedure and they have been covered in different assessment altogether, that is block assessment under chapter 14B. What this provision proposes, what this provision says, this provision simply says that now for issuing notice under section 148, inquiry is to be done. Inquiry, yes, he will do, assessing officer will do inquiry. Show cause notices will be issued. Show cause notice will be issued as to why assessing's income escaping assessment should not be done. Assessee has to furnish response, but now time limit has been removed. No time limit. Assessing officer will specify the time limit in the or notice therein. In that time limit only assessee has to reply. Based on the facts, AO has to pass order. AO has to pass order that whether this case is perfect for income escaping assessment or not. Once this case is done, then AO will serve a notice under section 148. For serving notice under section 148, AO must have information. Earlier, AO used to have information in 8 instances. Now AO has information only in 6 instances. All the cases remain the same. But sir, in case of search requisition, in case of other party search, sir, AO does not have any information. Why? Because this will be covered in different assessment altogether now. Earlier, AO used to have information in 8 cases. Now 6 cases. 2 cases that have been removed. They are removed intentionally because they have been covered in different assessment altogether. AO must have complied with section 148A. Sir, AO must have complied with 148A. Yes, sir, he will comply only. He will comply only. No issue whatsoever. He will comply. No issue whatsoever. Sir, earlier we used to have three cases where AO was not required to comply with 148 a show cause notice. Now we have only one case. Search has been removed from here. So search has been removed from here. Requisition has been removed from here. Other party search has been removed from here. Only section 135A is left. Only 135A is left. And before passing the order under section 148A, sir, assessing officer has to take prior approval. And whose prior approval assessing officer requires? Now in this case, prior approval is required by via joint commissioner, joint directioner, additional commissioner, additional director. Also, search has been removed from this case. Requisition has been removed, and other party search has been removed. So in this case, so earlier also assessing officer was not required to send any show cause notice. Now also he is not required because in these three cases we have different assessment procedure altogether. And for section 135, assessing officer is not required. Assessing officer is not required. Just take prior approval. He already has information and he can proceed. He can start with proceedings under section 148. He can simply start with proceedings under section 148. So what things have changed? Earlier we used to have show cause notice. Now show cause notice. Earlier inquiry was earlier prior approval was required from CIT, PCIT, CCIT, and PCCIT. Now prior approval is required from additional commissioner, joint commissioner, as additional director, joint director. Earlier, in three cases, show cause notice was not required to be served, but now in only in one case, show cause notice is not required to be served. Search case has been removed. Search case has been separately discussed in different assessment procedure. 148 was required to be served and return was required to be filed. For that matter, two conditions were required. Sir, AO must have information and 148A is already complied. AO had information earlier in 8 cases. Now they have only in 6 cases. Almost all cases are same, but search and other party search have been excluded in these cases. Simple provision. Only search is excluded. Power to issue show cause notice under section 148 has been reduced to lower level authorities. These are the minor changes, and time limits that earlier we used to have been removed substantially. These are the major changes that have come in income escaping assessment. These are major changes that have come in income escaping assessment. Let's read it in the book once. Same provisions, you need not to worry at all. Same provisions that we have studied now are given here. Sir, whenever income escaping assessment is happening on account of faceless assessment, on account of risk management strategy of CBDT, DTAA, or audit objection. In these 4 cases, assessment will be done by joint commission only and not below the level of that. Assessment will be done by joint commission. In other cases, assessing officer or ITO can also do income escaping assessment, but in other cases, joint commission has to do approval. It's a time limit to issue notice under section 148. What earlier used to happen was, assessing officer had multiple time to issue has sufficient time to issue notice under section 148, that is regular notice, not show cause notice but regular notice under section 148. Assessing officer used to have two time limits, 3 years and 10 years, 3 years and 10 years, depending upon amount of income that has escaped. Now we have dual time period. What this dual time period is: now assessing officer has to take care of 148 a time limit also and 148 time limit. What this provision says, if income escaped is exceeding 5 lakh rupees, then assessing officer can send a show cause notice under section 148 up to 5 years. So up to 5 years from the end of the relevant assessment year, or in case income escaped has lesser than 50 lakh rupees, then 3 years from end of RAY, from end of relevant assessment year. That means for previous year 24-25, assessment year 25-26, last date to send notice under section 148A is, sir, 31st March 2029. This is the last day to issue show cause notice. If income escaped is lesser than 50 lakh rupees, 3 years from end of RAY. If income escaped exceeds 50 lakh rupees, 5 years from end of RAY. This is major amendment time limit to issue notice under section 148A. 148A, show cause notice. This is the time limit for show cause notice. And time limit to issue notice, regular notice, so this has to be 3 months from the end. What it says: whenever income escaped is up to 50 lakh rupees, then 3 years, 3 months from end of RAY, and income escaped exceeds 50 lakh rupees, then in that case, it is 5 years and 3 months from end of RAY. 5 years and 3 months from the end of RAY. What this says: whatever the time limit that we have given for 148A, just add 3 months to them and calculate the date accordingly for 148 notice. Simply, if I am asked to say what is the time limit for issuing notices in this new income escaping assessment, is if income escaped is up to 50 lakh rupees. For show cause notice, 3 years from end of RAY. And for 148 notice, 3 years, 3 months from end of RAY. If income escape exceeds 50 lakh rupees for show cause notice, 5 years from end of RAY. And 148 notice, 5 years, 3 months from end of RAY. That is the bottom line. This has changed. Earlier, prior approval was required. If notice was sent within 3 years, then CIT, PCIT, these were required. But if exceeding 3 years, then CIT, CCIT, PCCIT approval was required. But with effect from 1st October to 1st September 2024, AO has to take permission of Joint Commissioner, Joint Director. Only these smaller people can give approval for issuing notices. No issue whatsoever. What else amendments? We do not have any other amendment in this. We do not have any other amendment in this. Things are almost similar. Things are almost similar otherwise. One thing that has also changed is, do you remember was section 144C? 144C talks about DRP, Dispute Resolution Panel. In case if order is passed for a foreign company or non-resident, or order is passed on account of reference to transfer pricing officer, then assessing officer is bound to serve a draft order to assessee. Assessing officer is bound to serve a draft order to assessee. Now, assessee can either accept this draft order. So AO will confirm this draft order and make it final order. SSC can ignore this draft order and let AO will finalize the draft order. AO will finalize the draft order and make it final order. SSC can appeal against that DRP. Sorry, at CIT appeals. CIT appeals, SSC can appeals. But SSC can object to this draft order also. SSC can object to this draft order. And once SSC objects to this draft order, he has an option to object it at DRP. With effect from 1st September 2024. If such draft order pertains to assessment relating to search cases, this can never be objected. Even though it has been referred to transfer pricing officer, even though if draft order pertains to any non-resident or foreign company, in that case, SSC cannot object to DRP. These draft order provisions will not apply in case of search assessment procedure. Now, what the search assessment is, what things have changed in the search assessment. So, for that matter, we need to understand Chapter 14B. Very simple provision. It seems complicated, but it is really simple. It is really simple. Understand along with me what this says. Provision says, first of all, understanding block provisions, understanding the assessment procedure, we need to understand certain basic definitions. What these basic definitions are all about, first of all, is block period. What this block period is. Provision says, whenever a search has been concluded at a person's residence or at any premises. For example, a search is concluded on 1st October 2024. Yeah, 1st November 2024. Consider that previous year. Consider that previous year. Sir, what is that previous year? Previous year 24-25. And take 6 preceding financial years. The previous year 22, 20, 23, 24, 22, 23, 21, 22, 20, 21, 19, 20, and 18, 19. These are 6 preceding financial years. These are 6 preceding financial years, and this is the previous year of search. This nearly 6.7 months year, 6 years, 7 months period is considered as block period. So whenever I ask you whatever the block period is, what do you understand? So block period implies year of search and 6 preceding financial years. Previous to year of search. This is block period. What did I say? Previous year of search and 6 preceding financial years preceding to year of search. These period we have understood from block period. Did you get this point or not? Block period, sir, year of search and 6 preceding financial years. We do understand this point. Second term is undisclosed income. Sir, any kind of asset, any kind of income, any kind of expenditure that has not been disclosed in your books of accounts, or that has not been disclosed to income tax, is undisclosed income. You have incurred any expenditure, you do not have any proof. You have an asset, you do not have that book, you do not have proof. How did you acquire that asset? You have money, you do not have proof. How did you earn it? So such things are considered as undisclosed income. We are here to tax such undisclosed income of such block period. Now, assessment will not go year wise. Assessment will go for that block period as a whole. Assessment will go for block period as a whole. Now, individual assessments will abate. Individual assessment will have no regard. We will assess whole block as a whole. And government intends to tax the undisclosed income. Government does not intend to tax any income that has already been taxed now. That has already been taxed. Government does not intend to tax it at all. Government just wants to tax income which has not been disclosed. So this is undisclosed income. Third important term is the conclusion of search and requisition. What this point says. This point implies, sir, search implies, sir, last date of last panchnama drawn. What this says, sir, whenever search is occurred at a premises, income tax authorities or officials, what they do is they either seize the asset, they make the list of the inventory, they make the list of the items that have been seized, that have been searched, they have found whatever the stock they have seen, whatever the cash they have seen, whatever cash they are taking, they draw out a list of the things, and the day on which such list has been stamped, it is called the date of search. It is called date of conclusion of search. It is the day on which Panchnama is drawn, or it is the date of conclusion of search. Similarly, for requisition, whenever any search occurs under any act, for example, for Rahul, search has been occurred under PMLA. So PMLA guys will tell income tax wale people na, that he has certain income escaped assessment. So income tax wale people will send a notice to me na, and income tax wale log will require books of accounts from this PMLA wale people. So whenever the books are received by such income tax officials from any other act, that is considered as date of receipt of books of accounts, and that is called conclusion of requisition. Simple provision. Three terms we have understood: block period, undisclosed income, conclusion of search. Fourth point, basic point. Sir, it is possible now for previous year 20 during previous year 24-25, whenever search has occurred at my premises, assessment for either or multiple years have already completed. It is possible now. Assessment for 18-19 is already completed. Or assessment for 19-20 is pending. Assessment for 20-21 is pending. So assessment must be either pending or it must be completed. It is possible. Yes, sir. It is possible. Provision says whenever search will commence, sir, any pending assessment for such block period will abate. It will abate. It will loosen up. It will lose its value. AO will stop doing assessment. AO will stop doing assessment. For any last 6 preceding years, if any of the assessment is pending, AO will stop doing assessment. It will lose out. It will have no value. So any order that has been passed by TPO will lose its value. So provision says any kind of appeal that is with CIT or Joint Commission Appeals or any ITAT, so it will not abate. It will still have its value, or any kind of revision that has been seeked with Commissioner, it will continue to have value. Provision says, for example, for previous year 24-25, search was occurred on 1st of November 2024. So what will be the block period? Block period will be previous year 22 to 23-24 from previous year 18-19 to previous year 20-24. This is the block period. This is the block period. Yes, yes, yes. This will be the block period. Yes, sir. This will be the block period. Now, as soon as search is concluded, is it possible? Is it possible that search will again be concluded at my premises? Search can again be constituted at my premises. Yes, sir. Search can again happen at my premises. For example, search occurs again in May 2025. Again, search occurs at May 22, 2025. Now, again, department will initiate these assessment proceedings against me for the new block period. Department will initiate new proceedings for new block period. And this new block period will comprise of 5 those similar periods which is already under assessment. What I'm saying, just listen to this point. What this point says, just give me a second. For example, search is started on 1st November 2024. Now again, new search is started on 1st May 2025. And for this period, new block period is previous year 1920 to previous year 24-25. Almost, sir, 5 years are similar now. 5 years are similar now. 5 years are already similar for this search period. Now, in this case, provision says this assessment will not start unless assessment order for this period is completely finalized. Unless assessment of first search is not completed, assessing officer will not start the assessment of second search. This is the provision. What will happen When search is concluded, department came, income tax authorities came, they found out my books, they found out my investments. They concluded the search, they seized the assets, my all previous assessments were abated. Now what will happen? Department will ask me to file a return of income under section 158 BC. They will ask me to return, they will ask me to file a new return under section 115 BC, 158 BC. This is not return under section 139(1), not 139(4), not 8A, not 142(1), not 147. No, sir, this is different return altogether. Sir, but this will possess the nature of 139(1) if filed on time. If return under section 158 BC is filed on time, it will be return under section 139. It's not filed on time, so it will never be return 139(1). That means department, if wishes, can accept this return or can reject this return also. So this return must be furnished within 60 days as may be specified in the notice, but not exceeding 60 days. I mean, assessing officer can require assessee to furnish return within 60 days, but not beyond that. It can be 10 days, it can be 15 days, it can be 20 days. Assessing officer can prescribe any amount of time to file the return, but it cannot exceed 60 days. So once return has been furnished, return will be considered as 139, return under section 139, and notice under section 143(2) will be served. Sir, what 143(2) is? Notice for scrutiny, if you remember. Now, in this case, sir, income escaping assessment proceedings will not start. Sir, in this case, scrutiny assessment will start. Scrutiny notice will be sent to you. Department will seek information from you. You have to furnish the information, and based on that, assessing officer will find out the pass the final order. Department already has information that is found during the search. Department also wants information from you. Department also will take information from other parties, and all in all, it will compile the information and pass the order. In this case, whatever the assessment that will be done, it will be done it will be done under section 143.3, read along with chapter 14b. Whatever the order will be passed, it will be passed in this way. So provision says, if it is filed, if the return under section 158 BC is filed beyond it, it will not be considered as return under section 139. That means department either can accept this return or can reject this return. No notice under section 148 can be issued, sir. This assessment is different altogether. Sir, no income escaping assessment proceedings will start here. And sir, the last and the most important, you cannot revise this return. You cannot revise this return. And next point, sir, yes. You cannot revise this return. You will not be even given intimation for this intimation under section 143(1). Remember, whenever you file a return, you get intimation order. You will not get intimation. Sir, this is assessment. This is search assessment altogether. You will not get any intimation. Provision says once assessee furnishes the return, department will find out the information. Department will do different measures to find out the information. Department will do best judgment assessment. Department will do other party search. Department will do baseless collection. Department will do 133(6) information collection, so that information about the assessee can be brought together. Based on that, sir, department will find out the total income of the block period and pass the order accordingly. But sir, you have to remember, nothing in this chapter shall apply. Sorry, nothing in this, nothing in section 144C shall apply in respect of this order. Whenever final order is being passed or draft order is being prepared, it will not be sent to SSC. Even if order is with respect to non-resident SSC or foreign company. Even if order is in respect to order passed by transfer pricing officer, so it will not be sent to SSC. SSC has no right to object it, nor he can go to DRP. Provision says, whenever assessing officer does assessment under these provisions under chapter 14B, the prior approval of additional commissioner is required. If additional commissioner, joint commissioner, additional director, joint director, of these four authorities, assessing officer can take approval from any of these authorities. So you have to make sure, sir, assessment order under this chapter cannot be passed by the order below the level of assistant commissioner, joint commissioner, assistant director, deputy director. So you must be remembering, we had income tax authorities like this: PCCIT, CCIT, PCIT, and CIT. Below that we have, sir, joint commissioner, assistant, additional commissioner, assistant commissioner, deputy commissioner, and ITO we have. Here we have PDGIT, PGIT. Here we have PDIT, or we have DIT. Below that we have additional DIT and joint DIT, joint director. We have additional director and deputy director. This is the income tax authorities hierarchy. Now, approval is to be given by them. Approval is to be given by them, and assessment can be done only by them. This bigger block can do assessment, but approval has to be taken from this above smaller block people. ITO cannot do assessment. Once assessment order is passed, how total income will be determined? That is the point of the issue. That is the point of the issue. The provision says something beautifully. Provision says something beautifully. So you have to bifurcate the year of search. You have to bifurcate the year of search in two periods. First period will be year in which search is concluded, and second year will be preceding 6 block period. Like in previous year 24-25 search was concluded in my premises. So previous year 24-25 has to be assessed separately, and previous year preceding 6 previous year have to be assessed separately. For that matter, how total income for that whole block period will be calculated, we have been given a formula for that. We have been given formula for that. What formula has been given? What formula it says? First of all, let us understand an example. For previous year 24-25 and previous year 23-24, 22-23, 21-22, 2021, 1920, and 1819. These are the 6 block periods. These are the 6 block period along with year of search. In this year, we have already declared income of sir, for example, 10 lakh. Previous year 2023 declared income 10 lakh. 21-22 assessed income under section 143.3 12 lakh. Declared income 5 lakh. Assessed income 12 lakh. Declared income 12 lakh. This has been the history in the 6 years. How block income will be declared? First of all, you have to find out the undisclosed income that assessee declares himself. For example, search occurred in the premises of mine. I already know what department information already has. Department has. So I am declaring extra assets that have never been disclosed. First of all, that information will be taken. For example, if I have already declared my house, this will not be declared again. This will not be declared again. I have already disclosed this house to income tax department. This will not be disclosed again. So, for example, if I have a house at Lonavala, that undisclosed asset I have to disclose. First of all, what provision says? Total income disclosed in the return under section 158 BC by the assessee. Whatever income that has not been disclosed but is disclosed now by the assessee will be added here. So, for example, me myself declare that I have a house of 2 crore rupees at Lonavala. That I am declaring. This is something that I have not declared previously on income tax. This is something I have not declared to income tax. Yes, sir. This is the first thing. Second thing, total income assessed under section 143.3, 144, 147, 158. So whatever the income that I have that have been assessed under these sections. So till date, only 2 assessments have been completed with respect to block period. First is previous year 21-22 and second is previous year 19-20. If I add them, it is 12 lakh rupees. Just add 12 lakh rupees. Years for which assessment has been completed. Third provision, total income which is declared under return under section 139. Total income which has been declared. So sir, 10 lakh has been declared. 10 lakh again has been declared, 5 and 12. So in total, if I am asked, so we have 37 lakh rupees has been declared income. 37 lakh has been declared income. Fourth point, total income determined for the previous year that has not ended. That means year of search as per books of accounts. So sir, for example, previous year 24-25, we have to calculate. For example, we have 4 lakh of income. This will be added. And last point is income that assessing officer finds out. Income that assessing officer finds out, and I have also not declared that income. See, what happens is I can have multiple incomes then. Some income I have declared, some income I have not declared. Out of the incomes that I have not declared, some incomes that I am declaring right now. There are certain incomes that I might have not declared, and assessing officer knows that and it finds out. Getting me? Provision says first point you have to add up incomes that you have not declared and you are declaring right now. Last point says income that you have not declared and again you have not declared. Assessing officer suo moto finds out your income and adds to your income. This will also be considered as undisclosed income. For example, assessing officer finds out that I have a flat in Goa. I have a flat in Goa worth rupees 5 crore rupees and I have not disclosed that. So that will also be included in this block period income. Something I declare, something assessing officer finds out that I have not declared. These are two things that are undisclosed income, and the things that are already disclosed is of no relevance. These things that I've already disclosed are of no relevance. So in total, block income will come after adding all the five incomes. But the fact is, so this is already declared. This is already assessed. This is of previous year that is not completed. So doing assessment will make no sense. Therefore, we have to add 1, 2, 3, 4, 5, and we have to reduce 2, 3, 4 to find out the total income for the block, which is taxable. Ultimately, sir, whatever income that has not been disclosed is taxable. Is taxable. Whatever income that has not been disclosed is taxable. What I'm saying is, we have two kinds of income, either disclosed income, undisclosed income. Whatever income that has been disclosed, either assessed in assessed form or in self-assessment form, will be added in point number 2 and 3. Whatever the income of the previous year that has not been ended, that is previous year of search, will be added in point number 4. So this is either disclosed or either assessed. That means these incomes are the income that department already knows. But whatever the income that is being disclosed by me in point number 1, the department does not know that I am declaring suo moto in this return. So that will be firstly added. And second thing, department finds out certain incomes and adds itself. That I have even not declared, department finds out from somewhere and adds to my income. That is point number 1, and point number 5 are the incomes that are actually undisclosed income. So that will be considered for the purpose of taxing purpose. So whatever the income that we find out for this block period, what provision says, so that will be total income for the block period, which is taxable, and such income will be taxed at the rate 50, that will be taxed at 60%. 60% will be taxed rate on that income. Not just 60%, sir. 60% is easier to tax. 60% is easier to tax. Sir, you have to add surcharge to such income. You have to add education cess to such income. Sir, you have to add not just surcharge, not just tax, but sir, penalty equal to 50% of taxes. You have to pay. Provision says, if there is reasonable cause of failure, if you pay taxes on time, if you file return on time, if you declare suo moto, then in that case, whenever assessing officer feels that penalty should not be leviable, he will not levy penalty. But still, taxes will be applicable. Taxes at that 60% will be applicable. You have to pay taxes 60%, plus surcharge plus education cess. That is the bottom line. Sir, interest under section 240 through 24234A, B, C is not applicable. Provision of misreporting and underreporting are not applicable. So these penalties of misreporting and underreporting will not apply. Got this point or not? So whatever the income that will be computed on the basis on certain reasonable basis. You must have certain proof of having such income. You cannot add on ad hoc basis add such income. You must have had certain proofs. So provision says, since we have divided two periods, year of search and 6 years preceding to previous year of search, if assessing officer finds out any international transaction in year of search, then it will not be considered, because it will be considered in previous year or in next subsequent year, because he will file return in next year. So AO will consider income in next previous year only. But for 6 preceding financial years which have already concluded, because of for which assessment is already done, in that case, sir, in that case, AO will consider such incomes and will calculate arm's length price if required. Provision says, if a partnership firm is under assessment, if firm is under assessment or LLP is under assessment, then any kind of salary, any kind of interest, any kind of remuneration, any kind of commission paid to non-working partner shall be disallowed, and assessment shall be completed accordingly. Provision says, if we have any brought forward losses prior to block, if we have any brought forward losses prior to block period, then that losses cannot be set off against the income that has been found in the search assessment. You cannot set off such losses that has been found in this search assessment cases. You can carry forward such losses if allowed, if time limit permits, but you cannot set off such losses against the income that has been disclosed or undisclosed in search cases. Other points that need to be taken: time limit to be complete. Achha, one important point, what this point says. This point says, sir, for example, if search is initiated at my premises, first point we had studied, now whatever the pending assessments were, they will abate, they will lose down. What if search assessment is done, order is passed, and I went to CIT appeals to fight for this assessment? I went to CIT appeals to fight for this assessment. and I won at CIT, and because of which this search assessment is annulled. This has been deleted by CIT appeals. This has been deleted by CIT appeals. Now, since this order has been deleted by CIT appeals, provisions as whatever those abated provisions were, na, that will revive. That will revive. Simple provision. What it says, sir, because of search assessment, whatever the order is passed, if such order is being set aside by CIT appeals, then whatever such abated provisions were will revive. But if again department goes to ITAT and that search assessment order is again revived, then in that case, such revived provisions will again abate. What do you understand? What do you understand simply now? What it says simply, whenever such assessment order is being set aside or has been annulled in appeal, then earlier abated provisions shall revive. But if such annulled has been again revived, such assessment is again revived, such annulled assessment is again revived at ITAT or High Court, in that case, whatever such revived provisions were will again abate in that case. Ultimately, either you have to suffer the search assessment. If search assessment is set aside, then or previous assessments will continue. If such assessments are again, if such assessment is again revived, then in that case, previous assessments will again abate. This process will continue. So if you do not pay, if you do not pay taxes on time, or you do not furnish return on time, you will be charged interest at the rate 1.5% per month from the date commencing from 61st day of file of 61st day of due date. That means you are asked to file return in 60 days now. If you do not file return in 60 days, from 61st day you are required to pay you are required to pay interest at the rate 1.5% till the date of passing of the final order. Till the date of passing of the final order. You are charged 50% penalty in respect of undisclosed income, but no penalty will be leviable if person declares such income in return, pays tax accordingly, pays shows evidence of tax, and do not file appeal. So this same assessment is applicable for search cases. This assessment is applicable for even requisition cases also. Also, last point says, sir, if search occurs at any other place, for example, search occurs at Mehul's premises, and at Mehul's premises, so department found out books of mine, assets of mine. At Mehul's building, he finds out registry of mining. At Mehul's premises, department finds out that Rahul has bungalow in Dubai. In that case, they will start proceedings under this chapter only, chapter 14B. That is this newer search assessment. Did you get this point or not? This was all about your search assessment, or I should say, this was all about your amendments in CA Final DT for May and November 25. Till now, only this much amendments have come. I am 100% sure that these amendments will be much, much, much beneficial for you. And there is greater possibility that you might see nearly 10 to nearly 30 to 35 mark questions from these amendments only. Will not be amazed to see that much weightage of these amendments. So hoping you all enjoyed it. Do like this video, do comment down your experience, do comment down how you want other videos to be in English, what other videos I can make, so that anything that I do should add up to your knowledge. So thank you so much. You all have been great students. Enjoy studying. Bye bye. Take care and enjoy studying. See you guys in the next one.